we're going to start going to strategies. And the first one that we're going to cover, and I got lots of candidates for it, are covered calls. Okay. So let me give you the good news and the bad news with covered calls. In order to use this strategy, you've got to own 100 shares or more of a stock. Most of you, that's probably not a problem. If it is a problem, then keep in mind you can do this on inexpensive stocks. You can do covered calls on, one of the bank stocks that are in the 30s or 40s. Stock like Ford, which is under $11 a share. We've identified a bunch of really good candidates for this, but the basic concept behind a covered call, you want to make sure that you do this on a stock that you're happy to own. In other words, fundamentally strong. So I would probably start with that screener that I gave you with all those inputs. So we know all those are fundamentally strong, right? My preference for this strategy, large cap stocks, it's a value of 10 billion or more. We want to see an average daily volume of at least 1 million shares. That's already plugged into the screener. A dividend is not a must, but if I have a choice, see, knowing the psychology of investors and the fact that they don't like to sell their dividend payers. So you generally on dividend paying stocks have more price stability. So that's really what I'm looking for, a fairly stable price range. So if you ran through the bullish screener, you could put each one of those on a chart like you watched me do. And the ones that just kind of grind up, that don't have really big moves, those are fantastic candidates. If you don't own the stock, then you would buy the dip, right? Let the stock come down a little bit, and you could simultaneously, I'll show you how, buy the stock and sell a call against it. Now, the traditional way to do this is to sell at the money calls with a 30-day expiration. I'm going to give you a better approach than that. Okay. So let's take one of our candidates and I'll show you exactly step by step how to do this covered call and also the thinking behind it. Okay, let's use Coca-Cola. Wouldn't matter which one I used. So Coke is, nice, steady, large cap, dividend payer, checks all the boxes. Okay. So the first decision that you need to make is, are we going to do weekly options or are we going to short monthlies? Because of theta, the way that time decay works, by far you will get a higher rate of return doing weeklies than monthlies, like double. The disadvantage is that, in my case, every Friday, I'm rolling these trades over. If I did it monthly, then I'd only be rolling them over monthly, but I'm going to make half as much money. So to roll over a trade takes 1 to 2 minutes. To double my return, I'm willing to invest 1 to 2 minutes. How about you? So first determination, weeklies or monthlies. Let's say we're going to go weeklies. I will only do covered calls on stocks that have weekly options for that reason. Second decision, where do I want to set my strike price? So the closer you come, and the strike price is the price at which somebody else has the right to buy the stock from you. So the closer I get to the current price of the stock, the more I'm going to collect in premium, but I could also be giving up some upside. Now, what I do is forecast where do I think this stock is likely to be next Friday. And the best way to do that is you draw a trend line. So I'm going to give us a little more room here. And that's the trend line. So basically, I would expect the stock's going to get back up over here, which is roughly 72. So with that, get rid of that. Let me show you how you put on the trade. Now, it'll be different depending on what trading platform you're using. You know, everybody's brokerage firm is a little different, but I'm going to go into options. I'm going to go out 6 days. Normally I'm going out 7, but today is Saturday. So I'm putting these on Fridays, right? So it'd be 7. So we're going to use 6 days, and I'm not paying attention to delta. I'm simply paying attention to that strike price, which was 72. So what is that as a yield? Well, if I give somebody the right to buy the stock from me at 72, right now they'll pay 35 cents per share or $35 per contract. As a rate of return, and first, so we're talking 6 days. So I'm going to take 360, 365, and I'm divide by 6. So there are 60.8 6-day periods in a year. So I'm going to do my return. So if I could collect 35 cents, divide that by the price of the stock, 71.64, multiply that by 60.8, this will annualize the return. So doing covered calls at current prices, if Coke doesn't go up 1 penny, that'll generate about 30% cash flow for the year. So for every 100,000, generating 30,000. If you had $1 million and it was all in Coke stock, which you wouldn't, but that generates 300,000. I say that for my friends out there that have $1 million portfolios and you're not creating any cash flow on it. So let's say I wanted to do one contract on 100 shares. What does it look like? First thing I'm going to do is I'm going to short. I'm going to sell that September 20th 72 strike. I'm going to hit the trade button. And then I'm going to add to it the stock. So you are simultaneously buying 100 shares of Coke stock while selling or shorting the 72 strike call that expires next Friday, September 27th. And I'm going to go to the mid and let's review the trade. If you want to take a picture of this. So we're buying Coke stock. We are selling one call option against it. And that would require $7,124, most all of which, of course, is going to buy the stock. And then you would submit that. Okay. So now I'm in the trade, right? What do we do next? Well, if Coke kind of stays about where it is, I don't do anything until next Friday. Next Friday, I would go into my trading account. I would find that short call and I would buy it back, buy to close. Simultaneously, I will then short a new one that expires the following Friday. So it would all come off as one trade. So on expiration date, I'm buying back the short call. Now you're going to have to learn how to do this. You're going to have to learn how to use your trading platform. We're going to buy back the short, and then we're going to short a new call that expires the following week. And in a perfect world, it just goes over and over and over again. And I just wash, rinse, repeat week after week after week. Okay. What if, on the other hand, the price of Coke starts to rise and it goes above my strike price of 72? If that happens, there's a chance that my stock could get bought away from me. Not a very good chance. Normally that happens at expiration, but there is that possibility. What would I do if the stock did get called away? So they just bought my stock for $72 a share. I take the money they paid me for my stock and I just go buy Coca-Cola stock again. And then I short a new call against it. It's not the end of the world. Some people act like getting called out on a stock is just some awful event. It's not. It's just an event. It's not a big deal. Now, what if Coke really started taking off? Here's the deal. To the extent that Coke is above $72 a share, I've capped my profit. So what I would do, let's say Wednesday of next week, Coke's at 75. I would buy back my short call, and then I would sell a new call with a higher strike, maybe 75, 76, expiring the following Friday. Now, if you're new to all this, that sounds a little bit complicated. It's really not if you'll go back and watch this. So the scenarios are, I put this covered call on, stock stays about where it is, I do nothing, I wait till Friday, buy that call back, and then sell a new call expiring the following week. At a strike price, again, I'd be looking at the chart asking, where do I think this stock will go between now and the next Friday? Stock goes up. If it makes a big move up and I don't feel like it's likely to come back down to 72, I will buy that option back and sell a new option at a higher strike. If the stock comes down, then what do I do? Well, if it comes, the only way that I could lose money is if the stock falls in the next 6 days more than 35 cents a share. If it falls more than that, okay, say the stock fell $1, big deal. I'm just going to short a new call for the next week. What if the stock made a big drop? Then what I'd have to ask myself, is this still a stock that I want to own? Right? Most of the time, the answer is yes, unless something systemic happened to it, like it missed on earnings or something like that. Otherwise, you realize stocks are going to go up, they're going to go down. We've seen it on every single one of them. It's just a part of the deal. So the real keys to success on covered calls, picking the right stocks that tend to behave themselves, and we're just buying the stock, selling a call against it. At expiration, we're buying that call back, and then we are selling expiring the next week. We just do it week after week after week. Typically, I'm in 10 to 15 of these a week. So every Friday morning, buying these calls back and selling new calls for the next week. And once you sort of get in the rhythm of it, so do a bunch of practice trades. It is a very simple thing to do. Okay. Let me take a few questions on covered calls. What causes breaks? Okay, I'm doing covered call. Question is, can you let it expire worthless? Yeah, but then you're out on the deal. So the reason I don't do that, I could let it expire, assuming it was out of the money, but then that means I've got to wait until Monday to do a new covered call. So I'm only going out 5 days. I'm only going to get 5 days of premium. Doing it the way that I do it, I'm going to get 7 days of premium. So there's a method to the madness. If letting it expire worthless was better, that's what I'd be doing, but it's not. How do you buy the call back? You go into your brokerage account, you buy it back. You're going to have to learn how to use your brokerage account. So you don't look at volatility. Nope. Otherwise, I'd have told you. When buying back your call, how much are you paying to close it out? Whatever it cost at that time. If it's out of the money, you're paying pennies, typically. On the Cisco, why didn't you? Okay, it has nothing with covered calls. If the price OS, I think you meant, is lower than the strike, why buy it back? So that I can do a new one. Otherwise, I could have 2 covered calls on my stock that leaves me naked on one of the contracts. Can you point out where to find the earnings whispers? Repeat what you do if the stock drops too much. I simply look to make sure I still want to own that stock. When you buy it back, where do you make money? You make money because if it's out of the money, what you collected when you sold it is greater than what it's going to cost you to buy back. Can show the pending trades for review again. I'm on covered calls. When you sell the call to collect the premium, do you need to have enough money to buy the stock? You already own the stock. That's the definition of a covered call. If you don't own the stock, then yeah, you'd have to have enough money to buy it. Why a covered call over a long call? It's a different strategy, right? A long call requires the stock to go up to make money. On a covered call, I could be making 30% on a stock that goes sideways. So A, it generates income, right? B, it's much more conservative. So it's not that one is better than another. It's just different. You almost bit on stock CCK. Okay. Oh, yeah, I said that the spreads were too much. Lost my connection. How far of a raise in the price of the stock do you have to worry about? When it gets to a level where I don't think it'll sink back down to its strike price, that's when I'll go buy it back. So that's kind of subjective. When you buy the call back, the ask is higher than the bid. Yeah, it's true. Always the ask is higher than the bid. Doesn't matter whether you're buying, selling, or doing nothing with it. The ask is always going to be higher than the bid. Do you set a limit or buy a put? Neither. I'm just doing covered calls. Do you need to use margin? No. Could you use a covered call example on Ford? You could go in and do it, right? Yeah, same thing, no different. If you already own 100 shares, would you just sell a call? Yeah, if you already own the stock, you don't need to buy the stock, obviously. You previously noted that when you are going long in a stock, you usually buy through a put, okay? Can you still do that with a covered call? Sure. 2 separate transactions. Covered calls are strictly to actually purchase the stock. No. Covered calls are to make income off of a stock that you own. How do you set the downside protection on the underlying? I just watch it. You know, if the stock is turned bearish, then I'll just close out the position, sell the stock, and go find something else. All right. Next strategy, which relates to a question that I got. You just were one step ahead of me. Using short puts. So I had said to you that to buy a stock, many times instead of just purchasing the stock, I will back into it by shorting a put against that stock. So I actually learned this strategy. I'm reading an article about Warren Buffett, again, greatest investor of all time, pretty good guy to copy. And in the article, it talked about the fact that, ironically, Coca-Cola, Buffett owns a lot of Coca-Cola, not a lot of Coke. Today's world, different connotation. So he owns a lot of Coca-Cola. He likes the company. He understands the product. And at the time, Coke was trading for $39 per share. And Buffett thought, I love my position, but if that stock ever came down to say 35, I'd be willing to buy everything I could get my hands on. So instead of just sitting there and hoping that the stock came down to 35, he shorted a put with a 35 strike, which would now obligate him to what? Buy the stock at 35, which he was, but now he's going to get paid. He did this for a year. So he received $1.50 in premium. And because of the